Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, welcome back to YouTube and welcome back to a look at oil. It should be a pretty quick one today. Very little has changed since the last time we looked at it. We're going to be using the CL2 chart to do our analysis. Right then, so oil is not one of the popular ones on the channel, which is fair enough. I imagine it's quite boring for most people, but the thing is, to me, at the end of the day, oil is actually very interesting, and the chart itself is very interesting at the moment, and we're going to talk about why. I mean, this thing feeds into everything. You know, this feeds into inflation, future interest rate predictions as a result of the effect of inflation, GDP. This speaks into everything, oil does. So it is important, but it's also interesting from a technical point of view, so let's talk about that. Before we go into all of the counts, let's just look at the chart in its naked form. And the first thing I want to do is I want to bring up support and resistance. And I want to take this long-term support that we come back to, 64.28, and I'm just going to extend it for a moment. I'm just going to get a horizontal, come over the same point, and you can see how this is a pretty important level, 64.28. We've tested prior support here, prior support here, which was resistance becoming support, which was resistance at a larger time frame here, which became support here, which was support here, which was resistance here. You know, and you could even argue its interactions go further back, but I'd argue it really begins with that first high back here and then progresses forward. So it's a major level. What we can also observe is a series of lower highs, series of descending highs. So from a classical analysis point of view, this looks very typically like two things. It looks like a head and shoulders, not the cleanest example of a head and shoulders, back to a neckline, but it is there, and it also resembles, a descending triangle. Right, back to support, and then downward slope. So both of these structures are bearish, right? There's no denying it. Probability on the larger time frame is to break to the downside for both their head and shoulder structure. It can be rejected, but the probability is to break to the downside for both a descending triangle and a head and shoulders. Now, it's not an Elliott wave triangle. Before you fellow Elliottians out there criticise me, in Elliott wave we have all sorts of triangles. We have symmetrical triangles, we have expanding triangles, we have barrier triangles, and we have running triangles, and this doesn't fit the bill for any of them. But we're not talking about triangles from the point of view as Elliottians. We're talking about how someone who wasn't familiar with that form of analysis might well view the chart, and they might well see a descending triangle, and they may well know that that tends to be a bearish structure. That doesn't cease to be true just because we're Elliottians. It is still true. Because of that, this is a bearish structure with a head and shoulders to back it up. So from the macro point of view, macro time frame, it looks bearish. Okay, end of story. It just does. That doesn't mean it's going to break down, but we have to acknowledge that. So we'll come back to that point in a little while, but first we're actually going to do the opposite. We're going to look at the bullish idea. Let's bring up the long-term count. We came into the lows of COVID, obviously, and then we had a move off of the COVID low into a wave 1, and then we came back into a wave 2. So let's come down to a smaller time frame here. So essentially, the invalidation point for the bullish count is 63.90, because we made that low, which we were assuming was the wave 2 low for the bullish count, back on the 3rd of May 2023. Since then, we have not broken that low. We have moved up in arguably 5 waves into a 1, and then we have corrected back arguably in 3 waves to a 2. This gives us an invalidation of 63.90, and that's all you really need to know. In the meantime, if the count is bullish, then we will start to clear all of these pivots out as we go. So the minor pivots of 77.60, 83.52, 63.85, and 92.42. These might not be exactly precise because I don't think I've actually adjusted them. So I will do. Actually, I'll do that now, so I can give you the exact pivots with only fair. And we can just save those again. I thought I had adjusted them, but I obviously, a bit neglectful of me, haven't been super precise. So let's try that again. So 77 spot 7, 83 spot 58, 86 spot 83, and 92 spot 48. We will break this downward trend line, descending trend line, and we'll break these pivots on the way back up. And if we do that, any bullish count off of a low increases in confidence each time we do it, until we clear this major pivot. It's a bit of an assumption that it's a major pivot because it does appear to be 5 waves up, so what I'm assuming in that circumstance is it's actually part of a flat pattern. That we did this, and therefore this whole move can be broken into a move down, a connecting wave, a B wave or an X wave for example, and then the next wave down. So all of these lower highs within this wave are smaller wave degrees, as these ones were in this wave, and this is the actual major pivot here of the A, B, C, and that's the one we're going to have the most confidence once we clear it. So that's essentially the bullish count. And in regards to, although we've got this macro bearish structure, we have to always be open-minded to being bullish, because sometimes the risk to reward ratio is actually on the side of the bulls, especially when you come back to long-term support and you come back to the lows. In this case, if we were to take a structural stop loss to the invalidation point for a long trade, we would be within 7% of the lows, which is about as tight, about as low volatility and narrower range as you're ever going to get in oil futures. So although it looks bearish, the longs have it from a risk management point of view. They don't have it from a probability point of view, the bears do. But from a risk management point of view, the long trade is the smaller risk. Now, it's not necessarily the higher probability of playing out. You have to understand the difference. Why would I say, oh well, the longs is not a bad trade at the moment? I'm not saying it's good or bad, I'm saying it's lower risk, right? It's important to manage risk. It's the most important thing there is in trading, is to manage risk. That's what we're supposed to be doing, right? Because the big wins are nice, but it's not the big wins which make you a long-term profitable trader. Okay, it's the small losses which do that. Win big, lose small. Okay, if you win big and lose big, you get nowhere. And if you win small and lose big, you're not going to survive very long at all. So, if you were to be long from here, using that structural stop, you lose less than 7% once you get stopped out. That's a pretty small loss. Obviously, we want to manage that exposure to this single oil trade within the greater risk profile of the entire portfolio we're managing, if we're managing a portfolio at all, and we want that overall risk as a rule to be around 10% or less. That's my personal rules, that's how I've always managed risk. You might be completely different, and depending on your own risk tolerance and profile, that suits you. But all I'm saying is, we're close to the lows, and therefore the risk management side of the trade is on the favor of is on the side of the bulls. The probability is still on the side of the bears. Okay, so on that note, let's move on to a couple of bearish counts. We've got this one here, and this gives us an A, B, C down, and uses the B wave as that flat pattern we spoke about. This is the major pivot here, and then the ending wave is actually an ending diagonal in a C. This ending diagonal cannot go beyond. Which shot does that one belong to? Okay, you can delete that now. That's no longer applicable. Sorry, excuse me. So this ending diagonal cannot come back or cannot come through 5 spot 3-4, because the fifth wave has to be shorter than the third wave in a contracting diagonal, and that's what this is. This would be recognised as the falling wedge by classical analysts. Analysts. There you go. So this would be a descending wedge, or what we call an ending diagonal. Okay, and the 5 can't be longer than the 3, so this would have to stop before 55 spot 3-4, and this would bring us straight into demand zone and straight into the golden ratio. Right, the golden zone, 61.8 to 65%. Okay, 61.8 being the golden ratio, Fibonacci golden ratio. We could just come down, kiss this, grab a bunch of liquidity by breaking long-term support, which would take out a bunch of stops which had been in place since the 3rd of May. Big liquidity grab, everyone gets bearish, and that's the perfect opportunity to bounce and just screw everybody twice. Screw all the longs here, screw all the shorts here, and you get that big liquidity bounce, and we're off to the moon, right? That's a possibility. It wouldn't be the first time I've seen that kind of play occur. It happens frequently because it hurts the most people, and the markets are obsessed. If they were conscious entities, they'd be evil, because they're always out to hurt people. But they're not actually out to hurt people at all. They're there to find liquidity. That's what they're trying to do. They're trying to tap that liquidity. And we know that there'll be a bunch of trades still hanging in their longs since those lows. Okay, there might even be a bunch of long trades coming in since, right, which are still using that May low as a cutoff. Right, and if that were to break, we grab all of that, and then we grab a whole bunch of bears who are silly people because they trade breakouts rather than retracements, and then they get shellackered, and off we go as well. That's a possibility. But there is another one, which is a very bearish structure. Very bearish structure. And the one I'm secretly, sounds awful, but secretly keeping my fingers crossed for from a trading perspective, because it offers an amazing opportunity. You know, I've said many times that the move off of the COVID low when oil on the WTI traded at zero, one of the most, I'd argue the most obvious buy in the history of the human species, was when oil went to zero. If you don't buy that, you need your head read. But either way, I've often argued that was a once in a lifetime, if not a once in the entire history of our species opportunity, right, to trade that. Not because it was the greatest possible returns ever, although infinite percent isn't bad. I'd argue that just from a point of view, you don't get to see something go to zero, which can't go to zero. Do you understand what I mean? You can't just say, oh, oil's gone to zero, it's a dead asset, it's over with. No, oil went to zero because of a manipulation, you know, an intentional and deliberate sabotage of our own economic system, right? But they didn't remove the dependency upon oil. So oil was going to go straight back up. That's what I mean by the biggest and most obvious opportunity in history, right? But we might be getting the next best thing. They move up and then move all the way back pretty much to those lows into a macro 1-2, right? So even, I mean, a second bite of the cherry that you would just never imagine could have happened, you know, when you came off of these lows, and yet it might happen. So there you go. That's really all I've got for you from an Elliott Wave point of view. A really short, sweet video today, but the point is these are the three counts then. So the bullish count is we've come back to support because the support's going to hold. We're going to break this downward trend. We're going to clear these pivots, and now's a good opportunity if you want to be long, right? The next alternative, the next idea is it's bearish, and we're going to finish in an ending diagonal, do a liquidity grab below support, hurt everyone both ways, and then rocket out of here. And then there's finally the one which is the macro head and shoulders, and descending triangle is going to play out at a macro degree, and it's going to wreck this market and just come crashing down into oblivion and provide another macro trading opportunity for those who weren't around during the COVID and got in afterwards. You know, so that's the way I see it, and they're the three counts, and that's just what you're watching. You're watching that support, you're watching that long-term support, and you're watching those pivots to see if we go up and clear them or whether we go down. But the opportunity now, long or short from those highs or long from these lows, it ain't going to get much tighter than where we are now. So you make your bet. You don't have to make any bet, you don't have to be included at all, you don't have to take any risk, it's totally up to you. But you're within, the closest larger pivot is within 14% for the shorts, and the closest largest pivot for the bulls is within 7% for the lows. So it's about as tight a range as you're ever going to get in an asset as volatile as oil. But you don't have to trade it, of course you don't. So there you go, let's have a quick look, wrap things up with our moving averages and some momentum indicators and see what we've got. So on the daily time frame, we are below the 10, the 20, 60 and 250 exponential moving averages, all of which are trending down following this lower sequence of lower highs and continuing to apply downward pressure to price. On the MACD, we are below the zero bound with the average and the signal line. No significant increase in bearish or bullish momentum. You know, duh. Been going sideways, haven't we? Neutral and the RSI, no significant strength or weakness one way or the other. Same story. Bullish divergence into the lows we've had recently though. Multiple weekly bullish divergence coming out of that low, but very little bullish momentum off of it, but it could be a sign that there's actually some strength building up. OBV not confirming one way or the other, still in a downward trend, but still above that major support level. So no preemptive breakout one way or the other. Weekly time frame. We are below the 10, the 20, the 60 and the 250 on the weekly time frame now. The 250 is still marginally trending up, but all of the moving averages are now trending downwards. So generally quite a lot of bullish, bearish pressure. But we did come all the way back to oversold conditions with the recent low. And we came all the way back to the recent low. What am I trying to say? We came all the way back to oversold conditions, on the weekly time frame. But what we see here is a confirmation from a closing price of that lower low. So we've got a low back here on the weekly, which is our intra-weekly low, which we're taking as our bottom, but it's not the closing low. You look at that candle, that's all wick. So we're actually confirming lower lows here with the RSI staying inside of that weekly range on the OBV, but it still feels bearish to me. If you'd had a closing candle on the weekly down here and then a higher close here on the weekly candle but lower readings in the RSI, this would be the reverse of bullish divergence RSI to price. This would be a hidden bullish divergence where price is taking the leading hint rather than the underlying strength. Can't say that though because it's not the case. So we're below all those major moving averages. We're in a downward trend of lower highs. We're back at support. We are getting squeezed and we're going to pop one way or the other. Macro odds probability. This is why I haven't got primary and alternate count because I'm not that confident to call it. But overall, looking more bearish than bullish. But ironically, risk tolerance from a trading point of view is on the side of the bulls for the moment. But if that support breaks, look out below. It could be a short-term liquidity grab like we've seen in our second count, or it could be a total collapse on the cards. So a lot of things will be decided in the next few weeks, and it could have a very serious impact upon economic data in the United States. Drill baby drill, as a certain individual was saying. If that were to become an overriding narrative, oil prices should anticipate lower future pricing and the market moves well in advance of actual numbers. So I'm not going to say any more. I'm going to leave it there, otherwise I'm going to start putting words into other people's mouths. So there you go, guys. Thank you very much for joining me on this technical analysis of oil. I will be back with you later in the week for another update on YouTube. Take care of yourselves and I'll see you soon. All the best. Bye bye.